welcome back to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. On this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I'm sitting down with Vizo Financial's SVP Chief Treasury Officer, Tim Sustak, and SVP Chief Investment Officer, Scott Wood. So let's get started. So I have a feeling there's not going to be a lot of debating today. I have a feeling you both are going to be on the same page, which I always like a good debate. So, but let's go ahead and jump in. So Scott, based on Powell's comments last Thursday, many feel the Fed will hold on raising rates next week. What are your thoughts?
Yes, I agree. There probably won't be a whole lot of debate today. We're probably all on the same page because Powell, yesterday met with the Economic Club of New York. He pretty much said that the Fed's not going to raise rates tomorrow. He said he's comfortable where the rates are right now, where the markets are at. He kind of did mention that inflation it looks like it's under control, or it's in a spot where they're comfortable. Although, recent trends haven't really indicated that. The last month or two, we've seen a slight uptick in readings, but Powell's comfortable with where we are. And a big part of this is because the markets have done some of the work for the Fed. In the last month or so, we've seen market rates. So usually the Fed is thought to control 2 years and shorter with Fed fund moves. And anything 2 years and longer, the markets tend to have more control over that than the Fed does. And what's happened here in the last month or so is those longer rates have been ticking higher. Effectively doing what the Fed is doing on the short end. It's tightening up economic conditions. It's making it more expensive for consumers to borrow, for businesses to borrow. It's having the effect of potentially slowing the economy, right? Because rates are higher. And we've seen this in some of the data recently. Existing home sales data that came out earlier this week. It was the lowest reading we've had. It was under 4 million homes on an annual basis. Lowest reading we've had since 2010 after the financial crisis, when people were handing in their keys to their homes because they couldn't make those payments. So there's, so mortgage rates in some cases, we're hearing 30-year mortgages have been hitting 8%. So the trend has been higher there in the high sevens until this week. We're actually been at 8%. The 10-year Treasury has almost hit 5% yesterday. Rates are a little bit lower today, but it was right knocking on the 5% door. So the markets have been doing a lot of the work for the Fed here recently. And then Powell went on to talk about that. He doesn't think it's the markets reacting to the Fed necessarily. He thinks it's other factors that are having an impact. So things like a really strong, resilient economy. The economy's held up very well, a lot better than people anticipated. So with a stronger economy, we see it in the consumer spending data. People are still spending money. I see it whenever I travel or go, whether it's up the road to go to the grocery store or something, or if you're on an airplane, everything's packed. I was in Gatlinburg this past weekend. It was absolutely chaos up there. The drive home, stop and go for the first 3 hours. I basically added an hour to my trip. The interstate was just a nightmare. And it's all these people that are spending money. But we're all spending money. So that the Fed has that in their favor, strong consumer. And then the other part of this is there's a lot of debt out there issued by our government, right? The last few administrations have not been shy about spending money. We've had the financial crisis and then the pandemic. There's been a lot of fiscal stimulus. Well, guess what? Our taxes haven't really gone up a whole lot, if at all. We've actually seen tax cuts. So what it means is more debt for the country. It means more supply. In order to absorb that supply, it's pushed rates a little bit higher. So he thinks it's been some of these external factors that have had an impact. But effectively, the markets have helped the Fed by raising rates here on the longer stuff. And when you look at Fed fund futures right now, there's less than a 2% chance that the Fed's going to raise here November 1st. So Powell effectively said no. The markets effectively said no. So we're looking at some point beyond this if the Fed does move again.
All right. My husband would also agree. I continue to spend money, so I'm helping to support the economy as well. So, Tim, loaded question. I'm going to guess you agree with Scott, but any additional comments there?
Yeah, I'm actually looking at a basis point increase November meeting. So, yeah, no, I agree with Scott 100%. I don't think they're going anywhere either. Just like most do. I think Scott covered all the points really, really well, and couldn't agree.
All right. Well, Tim, we still have one final Fed meeting of the year, which is December 12th and 13th. What's your prediction? Will the Fed raise at that time or hold?
Well, it's a good question. I think like everything else, I mean, it depends a lot on what happens between now and then. But I'm gonna kind of, thinking about it, my opinion is I think they're going to hold again, and I think that for a couple reasons. Number one is just recent Fed speak. I mean, just anecdotally, it seems like, at least from what I've read, there are plenty of Fed presidents out there that think that the Fed can afford to be patient. They want to see data. They want to make sure of where they're at. We have a sense that we're nearing the top of this rate cycle. I mean, the latest Fed projection, maybe one more 25 basis point increase. I don't think that's a given, although I do think that'll happen at some point. I don't think necessarily that has to happen in December. I think at this point they are, feeling like they're about where they are willing to watch a little bit and see what happens. And, I go back to what Scott mentioned, with Chair Powell's Club of New York. He was actually willing to say in there that they can afford to proceed carefully, as they go. And to Scott's point about the yield curve being higher, he mentioned that to do some of the work. So a lot of the things that are being said from the Fed, I think they've got to a point, and certainly not ruling out a future rate increase at all. I mean, you listen to what Chair Powell said there too. Inflation is still too high. Gives credit for the path that they've traveled and how much it's come down, but it's still too high. Recent economic releases. I mean, the job market is certainly still not. We're spending, pretty strong recently. So I don't think that we're certainly ruling any increase out. I think it's just more a matter of timing and when. My opinion is, as long as things stay the way they are now, I think they'll be willing to wait through December and see what happens. To Scott's point, you look at the yield curve, and I agree with everything Scott said about the reasons for the rise. I mean, just looking at rates now, 5 years yield about 488, up 29 over the month. 10-year 494. Scott said getting close to 5, up 50. The other thing too is I think finally maybe the markets have digested and they're starting to believe. And this is the other thing the Fed presidents keep saying is their rates are going to stay high all the time. The old higher argument. I think people are actually starting to take that to heart and believe it, after watching the economic data and realize, stuff isn't falling off. The economy still, even in the face of these higher rates. And I think they're starting to believe the Fed a little bit more. The bump in the yield curve will do some of the work for the Fed, and we'll see what happens. But I'm going to say no rate increase in December.
All right. Scott, are you agreeing with Tim there? No.
I think I would probably agree with Tim based on what we've talked about already. There's some there's more inflation, right? The Fed's going to have more readings to look at, so that's going to be a big driver of what they might do. But nobody expects a real big uptick in that it has recently. But maybe nothing too concerning right now, where the Fed could not skip in December also. If you asked me after the last Fed meeting, almost like a little over a month ago, I would have said probably the Fed would have raised at one of these. But that thing I think that's come in. But as Tim said, there's probably there's a good chance we could have another rate hike, whether it's December or potentially in January. But even then, it's not a given that we're going to see any more in the economy. Consumers continuing to spend. I will say there is a wild card to throw into this. Have a potential government shutdown mid. So they kind of dealt with that a couple of weeks ago. They pushed it off, but it's looming in again where that could be an issue. So if there's a government shutdown, that creates the economy. It creates issues for the Fed because they don't necessarily have access to all the data that's coming in that they would, and that could potentially delay decisions too on what they might do. If the data's not there. And part of the issue is we don't have a speaker in the House of Representatives right now. So I think Jim Jordan is going for vote number 3 today, and it doesn't look very promising. So something has this work, moving and working again. So there's that wild card out there, but it looks like the Fed is probably comfortable being on hold through the end of this year. Again, incoming data could change that because the Fed has told us they still are data dependent. They're still going to continue to look at the data and see what it looks like. And if we see a bad trend in inflation, certainly, they could make a move, but barring that, we'll probably wait and see what the new year brings us.
Okay. Well, let's talk about unemployment. So Scott, unemployment rates, they continue to stay around 3.8% and have since March of 2022. How does this impact credit unions and the staffing concerns and issues that they have?
A tough labor market if you're in a hire people. Real challenge. It has been a challenge for a while. I would say it's gotten a little bit better than it was a year or so ago. But it's still a very challenging situation. So the unemployment rate, as you mentioned, it's at 3.8%. Another indication that the economy is doing pretty well. People that, generally speaking, that want work can find it. No, there may be a mismatch between your skill set and what is available, but there are still many more jobs available than people out there looking for work. So the unemployment rate continues to remain low. The JOLTS job opening number, that did come down a month ago, but it's come back up again. So that's still high. So there are quite a few job openings. The one thing that has been positive, or a couple of things really have been positive for employers. One is the number of people quitting jobs voluntarily. That's slowed down. So there's fewer people just quitting and deciding to look for something else. And that's really an indication that there's some concern out there that about jobs, that they might, maybe they're like, okay, we've kind of run the course here. Let me stay where I'm at. So the number of quits has decreased. The other thing that might help credit unions and other people is that the wage growth has slowed a little bit here recently too. So we saw a big spike last year and earlier this year with inflation, people wanted bigger raises, which, as we all know, that slows inflation tremendously when you get pay raises. Just joking. That adds to the fever, right? Adds to the spending, as we've talked about. So, but people have got pay raises. We have, the UAW and others that are striking for better pay too. So it's still not a done issue, but the fact that wage growth has slowed, it's still growing, but it's slowed, has been beneficial. The fact that fewer people have been quitting is beneficial, but it's still a very tight labor market. So credit unions it doesn't mean that you're going to be able to go out there and if you had to raise your minimum starting salary to, let's say, $20 an hour, are you going to be able to back that down to 15 again? Probably not. You're not going to have really a whole lot of success with that. But you may have a little bit more potentially opportunity to hire the right people, but it still is a very tough labor market, and it's hard to find people, unfortunately.
Yeah. So Tim, what about liquidity? Are credit unions still feeling the impact of tight liquidity positions, or has that changed? And if it hasn't, what should they be looking to do?
Yeah, Jimmy, but unfortunately, it has not. we could say it's stabilizing a little here. We're getting into the fourth quarter where maybe there's not quite as much stress on liquidity as there is in the summer months, just in general. But yeah, I mean, liquidity is still a very hot topic out there. Credit unions are certainly still struggling for liquidity. I think we still have a bit of the have and the have-nots. And, as I call it, we've been experiencing that. I think, since liquidity has become an issue, those credit unions where, they're just really constantly struggling for liquidity, for whatever reason. It might be their membership makeup, or might be, how they've extended out in the investment portfolio, or just, loan demand, what have you. That's causing them trouble. And then others that seem to, not really be having very much of a problem with liquidity, for whatever reason, any of those, the flip side of that, any of those reasons. But I will say this, I think there's three things that will persist that will continue to cause pressure. One is the flight of deposits, right? So you kind of go back to the have and the have-nots, just, anecdotally, even the haves. Now, I think a lot of them are saying, look, we don't have any problem, but we're noticing deposits leaking out somewhat, whereas before hey, deposits are staying, now they're leaking out a bit. So that's kind of infiltrated, I think, a wider swath of the credit union movement. Because I think what we talked about, rates, heck, 100 basis point move in rates, probably the average person is not paying a whole lot of attention to. But when, you're earning 50 or 75 basis points in a share account, and all of a sudden you can earn 5% somewhere, people are waking up. And I think people are sensing, like, what we talked about here, that we're getting close to the end of this rate cycle. So even those who have been following and maybe holding off, waiting for the peak in rates, I think everybody's sensing, that's probably about here. So now is a great time, if you haven't shuffled some money, to do so. So I think that will continue. Credit unions will continue to need to fight for deposits and pay attention to that. Credit unions are still making loans as well, even with the increase in rates. Loan demand for some is still very hot. Some because maybe they're still priced below market, but others just because, people are catching up. Maybe you're not buying the new house now for a lot of those reasons Scott talked about. So maybe you're going to do something to fix up the current house, or you've been waiting for an automobile, and even though rates are high and prices are high, you can afford it. Now there's some more selection out in lots, so people are buying it. For whatever reason, there's still certainly some loan demand out there. I think the other issue is also what we talked about with the rise in the yield curve, especially those that extended out in the portfolio. This increase in rates in the mid and longer term is not going to be friendly to asset prices. So, we've seen a lot of credit unions struggling there. The callables that were supposed to get called didn't get called, and the mortgages have slowed down. And oh, by the way, now they're really getting hammered on price too, and you just can't stomach to sell them for the loss that you're going to take. And with the rise in the yield curve, that certainly isn't going to be better here, at least in the short term. So it's going to be even tougher to want to sell some assets, especially if they're maybe a little longer. I guess, what can they do? Well, I think the thing that we've been preaching first is make sure you get all the liquidity arrows in your quiver that you can, right? The time to get set up for, different liquidity options and plan for liquidity events strategically is when you're not having the problem, because once it's here, it makes it much tougher. So, look at what your options are. If you can, and you think your membership, is listening, pay your members first, right? Maybe you look at some rate specials to try and bring some money in from the membership. If that's not an option, we're certainly here for you with a line of credit. When's the last time you've checked on that? And we get requests every day for line increases right now for many reasons. People that are noticing they're getting short on cash. The examiner was in and asked for it. Some that just, hey, strategically we've grown, and we think we'd like to still have more of a cushion. Great. Take a look at that. Make sure you're comfortable with what you have there. Look at other external sources. Our Simply CD program has been wonderful for credit unions trying to raise cash, particularly, and don't get me wrong, it can get tough out there. Those that have cash get spent out a bit, and sometimes it's tough. But there's been a lot of funds raised through that marketplace, and particularly if you're a new issuer, if you haven't been in that marketplace, credit unions and other financial institutions get filled up on names because everybody's obviously trying to stay within the insurance limit. If you're a new issuer and you haven't been out there, easier to get uptake on that because your name's not been out there, and folks can add that name without having to worry about the insurance limit. So certainly, talk to Scott's folks, your CAMs on that if you haven't looked at that. Very easy to get signed up. And even if you don't use it, it doesn't cost you anything, but you have it at the ready. So that's another thing. Don't forget about Bank Term Funding Program. We still have credit unions that are asking about that, getting set up. That runs through, I want to say right now, March 12th, I think is the date. And you can take out a year loan even on the last day of the program. So if you've got eligible securities collateral, agencies, treasuries, things like that, and you need liquidity, take a look at that. It's hard to beat that deal, getting value for securities at par. You can pay off the loan whenever you want. It's really a great program. So take a look at that as well. Something else, a little maybe tougher if you're not into it right now. You need some policy and thing wrapped around that, but loan participations, and the nice thing about that is when the environment flips, and it will, at some point, liquidity strain will be a long lost memory, and we'll have liquidity again. Not only can you raise liquidity through loan participations, but you can purchase loans if you're having trouble making loans as well. And the same thing for Simplicity. It's an investment option, for when you have investable funds. So, you kind of kill two birds with one stone on that. But certainly try and fill up your quiver with as many arrows as you can to fight liquidity and to garner liquidity, both internally and externally. So that'd be the first thing. And I think the other thing is, we talked about maybe being more in touch with your members, trying to get some specials out there. I mean, credit unions know their members better than anybody else. So if that works for you or not. But the other thing is, it's a really good time if you haven't, and a lot have, but some still get surprises. Make sure you're paying attention to what your cash flows look like, both in the investment portfolio and the loan portfolio. And if you can, try and be patient and, rebuild your cash stores as you have things coming due. I know it's tough to give up income sometimes, but, you can go for quite some time with reduced or not making income at all. But as soon as you have a liquidity problem, you don't have access to cash, that's when things, bad things happen fast. So, I would just say be patient, be cautious, rebuild those liquidity stores, make sure you have all your tools in place, and, feel free to reach out to us anytime. We're here to help you.
All right. Thank you, Tim. So Scott, the holidays, they're right around the corner. Powell said inflation is still high. What should credit unions be watching for over the next few weeks as well as months?
Yeah, so inflation is still high. So obviously continue to look at those inflation numbers. Continue to, I think the key ones is going to be CPI, Consumer Price Index, and then the PCE deflator. That's kind of the Fed's preferred inflation measure. And that's the one that comes out, I believe, next Friday. But these are all monthly readings. Mm-hmm. So continue to look at those. If you see those spiking, trending higher, certainly be cautious, because the big concern of the Fed here is they brought inflation down from, let's say 9% at the peak in some of the readings, a little over 9%, to now in this 3 to 4% range. That's a big drop, but their target's 2%. And we've known this for a while. So if we start to see a trend heading higher, the Fed's probably going to get on top of that, because what they have to look at is what happened back in the late 70s and early 80s. We had really high inflation. The Fed was making what they thought was progress by raising rates, slowing the economy, and inflation came down. They kind of thought they had it beat, so they kind of took their foot off the pedal, and then they had to fight even harder as inflation shot back up again. So the Fed today does not want to repeat that mistake. So just be really careful look at those inflation numbers. The other thing that's really important is what we've talked about earlier, is looking at the unemployment numbers. We're at 3.8%. The Fed is comfortable if that rate goes higher. They told us coming into this tightening cycle that, they thought maybe 4.5% might be kind of where we ended up when they were done tightening, because they felt the tightening would, cause labor market issues, which we haven't really seen yet, as we've discussed, to any large degree. So keep an eye on the unemployment rate, but there's certainly room there for unemployment to tick higher before the Fed, it feels like they have to start lowering rates, which touches on what Tim mentioned earlier. The odds of the Fed lowering rates next year has kind of come down some, and are the number that they might do. Another big thing is what we talked about earlier too, is retail spending. Look at how strong the consumer is. Do they continue to spend money that they may or may not have? And I say that half jokingly because during the pandemic, we as in this country, consumers built up a really large amount of excess savings. Some of that was stimulus money coming into us directly. Some of it was just what we normally see when times get tough, when there's a recession. People tend to cut back. In this case, a lot of cases, they were forced to cut back because we couldn't travel. We couldn't eat out like we used to. But most of those excess spendings were expected to have been depleted by the end of last month, September. So those funds are effectively gone now. On top of that, we have the student loan payments that have re-engaged this month in October. So we had a 3-year hiatus on student loan payments. So for a lot of people, that was a positive thing that allowed them to continue to spend money. Economists say it could impact the average household with student loan debt anywhere from $200 to $400 a month. Not a huge number, certainly, but it does have an impact. And on the positive side, a lot of people have low mortgage rates. Those that had mortgages taken out a year or two ago, they could be in the sub 3% mortgage rate, and that frees up a lot of money, especially when you compare it to today's mortgage rates. But look at consumer spending and see how strong the consumer is. Continue to look at inflation numbers, especially CPI and PCE. And then, one thing to look at here too is how we come out of this, right? Is it a soft landing or is it a deep recession? And the Atlanta Fed does this GDP now. It's a projection of what GDP is going to be. So for the second quarter, we were a little over 2% for GDP. The projection for the third quarter by the Atlanta Fed right now is 5.4%. The markets think we're going to be in that over 3%, maybe 3.4%. So we could have a strong GDP in the third quarter. It's expected to slow after that, but how big of a slowdown do we see? Is it still positive? So obviously, keep an eye on GDP too, and see how that goes. And then I think the biggest thing of all is just continue to listen to the Fed. The Fed has been very transparent throughout this entire cycle, coming in, what they've been doing, and in a lot of cases, why they're doing it or why they feel a certain way. So if you listen to the Fed, you're probably going to be on the right side of the markets right now. So continue to listen to them. They hit about a week and a half or so before the next Fed meeting, they hit a quiet period. So their quiet period actually starts this Saturday, tomorrow. They hit a quiet period, and it goes till the day after the meeting. So the meeting's November 1st. So November 2nd will be a quiet day also. But then after that, they can start speaking again. So we'll have some comments today from a couple of Fed members about almost 2 weeks of quiet time until the meeting, of course, and then we'll hear Powell again and see what the Fed did. And then we'll have more talk after that. So pay attention to what the Fed members are thinking and saying. I think we talked about it last time we had this meeting, that we're starting to see some division at the Fed where there's a split. Some people think we're good right now. We can wait. There's others that think we should maybe raise. So just pay attention to what they're saying and what the trends are there, and especially what Chairman Powell has to say.
Thank you. Tim, any final thoughts for our listeners today?
I think just kind of, piggybacking on what Scott ended with there about listening to the Fed, accept where we're at, and this is the way it's going to be. And the reason I say that is because, I think there's, we came from a period of very low predictable interest rates, right? Not a lot of stress out there. Things were just kind of humming along. Everything was very predictable. And we got whipsawed. Rates rose really, really fast. It wasn't necessarily expected. I think the natural tendency was to, hope and wish that, we're gonna get back to lower rates. This is just a quick blip. You hear the markets talking about it, people talking about, they're gonna cut it. I mean, just accept, like you say, the Fed's, like Scott said, the Fed's been transparent. Accept that we're likely in a higher rate environment for a longer period of time. There is liquidity stress. Is it fun? Absolutely not. But you know what? You can manage through it. Don't wish for things to go back to the way they were. Assess your balance sheet and come up with a plan to manage in this environment, because that's where we're going to be for a while, I'm afraid.
Great. Well, as always, thank you both so much for joining me today. I appreciate you taking the time to share your insights with our listeners. Today's episode is brought to you by Vizo Financial's 2024 education. There are two things Vizo Financial absolutely loves: meeting with people and learning. Put them both together and you've got Vizo Financial's renowned conferences and workshops. See what Vizo Financial has coming up in 2024. You might just find something you can't wait to attend. Visit www.vfccu.org to see the full calendar of 2024 conferences and workshops. As always, thanks for listening.